Hello everyone and welcome to Finance JCL. I'm here to help you on your journey to financial freedom, and the focus today is on investing and the Bank of America. I'm going to look at the numbers and try and calculate a value for Bank of America, which is ticker symbol BAC, and that will help me decide whether I want to buy shares of the company or not, and hopefully will help you with your research into Bank of America as well. So the running order for today, I'm going to look at several aspects of the numbers for Bank of America, and this is profitability. I'll look at how likely they are to survive. I'll look at return on equity, dividend, and very importantly, book value. And I'll look at some things that perhaps aren't numbers, but are important, such as their moat and the industry. I will then calculate what I think the intrinsic value is, based on the book valuation method, and from that I'll look at the target price and with a margin of safety of 50%, and that's how I like to operate as a value investor, and therefore I'll share with you what action I'm going to take. Now, a couple of disclaimers for a start. Firstly, I do already own a position in Bank of America, and secondly, this is my interpretation. Please do your own research and take advice as necessary before you decide to trade in Bank of America. So start off by looking at free cash flow. Now, in my usual valuation methodology, I have several checks that I perform, and the company has to pass those checks in order for it to be considered for an investment. And the first thing I look at is the free cash flow. However, for a banking organisation, it's not really applicable because most of that value comes from balance sheets of financial assets and liabilities. So they're buying and selling money effectively, not physical goods, and the cash flows therefore aren't stable or predictable. And the free cash flow has ranged from 81 billion in 2010, it's minus 14 billion in 2012, it's been up and down all over the place, and in the trailing 12 months it's been 42.5 billion. So it's not really a good way to value the business. So I'm not going to assign it any points in my usual scoring matrix of dozen areas. So I like to look at the net income. First of all, the revenue for the company has been broadly stable in the last 8 to 9 years at between sort of 85 to 90 billion dollars ish. However, the net income has been improving. So first of all, for my scoring, it's positive. So that's the mandatory position. Now, ideally, the average would be above 20%, and over the last 10 years, it's 13%. Now, the actual margin has been above that in the last couple of years. So 2018 was 29%, 2019 28%. If you go back to 2010, 2011, 2012, it's hovering around about 0% plus or minus a few points. So it's definitely improved. So that trend is good. And if it continues as it is, it's going to be in that sort of desirable range for a long period of time. So for me, it gets quite a few marks in that net income bracket. Linked to that is the revenue. So the business is broadly stable, nothing surprising or worrying going on there. Let's look at the current ratio again. This isn't really applicable for banks. So for a normal company, I like a position where the current ratio is above 1 as a minimum, ideally above 2, but not applicable for banks. So then move to the debt to equity. So I don't want a business that holds too much debt because that could impact its ability to survive a shock. And then cash that it generates actually has to be spent on repaying debt rather than growing the business or being repaid to shareholders. So my mandatory position is a debt to equity below 2. Ideally, it's below 0.5. Now, in the case of Bank of America, it's very steady and it's been round about 1 for the last 5 or 6 years. So that's absolutely fine. Linked to that is interest coverage, but that's not applicable for a financial organisation, for a bank in particular. So we just move on to the moat. And the moat's an interesting one. According to Simply Wall Street, Warren Buffett, through Berkshire Hathaway, has been buying significant positions in Bank of America. Berkshire Hathaway is already the biggest shareholder of Bank of America. I think they own about 10% or so. And in 22nd July, 27th and 30th, they're taking big positions, and on the 4th of August. So quite a lot of buying, and we're talking well over 50 million shares. In fact, a bit more like 80 million shares over the summer. Pricing here has been around about $25. So from a Moat perspective, Warren Buffett's a big believer in Moat. He understands that business, and he wouldn't buy shares in the Bank of America unless he thought there was a moat. That's evidence of a moat, and also evidence of a good buy price there. Warren Buffett's buying around about $25 per share. Quote from some Morningstar analysis is that, quote, "We believe Bank of America possesses a wide moat based on sustainable cost advantages and switching costs that are consistent with our bank moat framework," end quote. So again, some expert organisation has done a review, and they believe there is a moat. So for me, that gets full marks in that moat section. Really big American bank, people in the know are buying shares and saying good things about the moat. Halfway through now, so just want to pause to invite you to support the channel. Now, if you're watching through YouTube, if you want to see more videos like this, do subscribe. And if you like this one in particular, hit that like button. And that's earlier the better for the YouTube algorithm. If you've got any questions, you want to have a chat, drop me a comment below. Another good way to support the channel is to join my Patreon club, where you can become a supporter or indeed a VIP patron where there are less than 20 slots remaining. So let's carry on. So look at the industry, financial industry, absolutely massive in America. It's not going away in the next 10 years. Although it's a mature industry, it is getting bigger, more and more electronic transactions, more transactions by card, population, economy growing. It's a good industry. I then like to look at the return on equity. Now, it's generally a bit lower for banks than it is for sort of non-financial organisations. But the return on equity history of Bank of America is that around 10 years ago, it was round about zero. And it just sort of started to improve over time to the fact that in 2018 and 2019 for the full year, it's getting towards 11%. Now I like a position above 8%. Now it's just dipped below that for the trailing 12 months, but for the last 2 full years it's been 10 to 11, so we're probably okay there. And over the 10-year period, the average has been just under 5%. And I like it over 20. Now that's not really realistic for a bank, but yeah, it's not as high as I'd like it to be. So we get some marks in the return on equity section. So dividend in shares is something I like to look at as well, and it's very important for financial institutions. So Bank of America has been growing its earnings per share over a period of time from zero pretty much, 2010 to 2011. And that earnings per share has now increased. 2018, $2.61. 2019, full year, $2.75. And the dividend was 4 cents for 4 years. And then in 2014, it went up to 12, and it's just been ticking up since then to 72 cents for the trailing 12 months. Even though that's been increasing quite a bit, the payout ratio on that was only 35%. So there is room for that dividend to grow further. There's potential more upside, which is good. And the other thing to note, of course, with that is there have been some share buybacks in the last few years. 11 billion shares outstanding in 2016, and that's dropped to 8.9 trading 12 months. Share buybacks, that also does improve the earnings per share. But look at all that together, the yield on the dividend, so that's comparing the dividend to the price, is 2.96%. So that's okay. The dividend looks quite good with room to grow, and it has been growing. So I think it gets full marks in that section. So the last two things I'd like to look at are to do with the valuation. So first of all, look at the price to earnings ratio, and that's 12. So it's pretty good. Banks generally are kind of in that 10 to 20 region. They're a bit more stable than growth companies. more importantly perhaps is the price to book. And I should say that all the data extracts here, the data information is from the Morningstar website. So I've got the price, the book value at $28.37 per share. Now that is effectively what we're saying is what the total assets minus total liabilities divided by the number of shares. So it's 28.37. But the actual price of a share is 24.31. So the book value per share is 0.86. So anything below 1 suggests potentially undervalued. You can buy $1 of value for 86 cents. That sounds quite interesting. Now banks tend to be the stable returns around about 1. And if they start dipping below them, that's it's worth looking at. So it's good, but ideally, we've got a small discount there, 14 cents on the dollar. But ideally, it would be a bit more to make it a bit of a no-brainer. So that concludes the kind of review of, is the company suitable for investment? Now they're making good margins, in particular the last few years. There's a big moat, it's a big industry, dividends decent and can grow, and the book value is below 1. So it suggests this is an interesting company. So I'm now going to try and calculate intrinsic value to see if it's actually on sale. Now I'm going to be doing this based on the book value because, as you mentioned at the beginning, the free cash flow that I use for most companies isn't really the appropriate valuation method for a bank. So look at the book value instead. So first of all, it works out the book value per share is 28.37. Now what I do with that value is I then look at the growth in that book value over the last 10 years, which is 3.22%. So I use that in my calculation. I also put in the fact that the book value is growing and the company's paying a dividend out, which is 0.72. So had it not paid that out, the book value growth would be even higher. And then what I like to do here is compare this to the safest thing possible. So if I had £1,000 or $1,000, what would I put that in that's the safest possible thing? If I didn't have a good company to invest in, that's the US 10-year Treasury note, which is 0.83% at the moment. It's quite a low rate. So use that as the discount rate because that is the safe alternative for my money. Nothing is safer. What that means, plug all that into a calculation. I calculate Bank of America is worth $42.75 per share as its intrinsic or underlying value. Now I compare that to the market price of $24.31. There's a big difference there. That is a margin of safety of 43%. So the price is 43% below what I calculate the intrinsic value of the company as. Now I like to have a margin of safety of 50%, so it's kind of like an amber type position here. So it's quite close, but it's not quite close enough. So my target price is 50% of the intrinsic value of $42.75. So I want to buy the shares in this company, or a piece of this company, at $21.38. Now it has hit that level twice in calendar year 2020 already, so it is possible, and it's only just above that level, about $3 above, so it's not too far away. The decision point for me here is I like the company, I have a position already, and I bought that early in the year when the price was a bit lower. Now I want to buy more shares in it, but I'm not going to do that until the price in the market is $21.38. So I'll set up an alert. When it does that, I will increase my position because the company is a good company. I think it's going to be around for the next 10 years at least. I want to hold it. Warren Buffett's buying it. It's got a moat, and if it's on sale at 50%, I want to increase my position. So that concludes the episode for today. I'd like to thank you for taking time out of your day to join me and look at Bank of America. I'd be really interested to hear what your comments are. If you can leave a comment below if you're watching on YouTube, and if you have a request for a company review, do get in touch, let me know. I've got a list of a handful that my audience tells me to review. I'll be very happy to do so. I'll try and work through those. just in closing, thank you very much, and I will see you next time.